You're listening to the Monocle Banking Podcast, as always curated by Monocle Solutions. And this week, we're talking about sustainable finance, but not the kind of green bond vanilla stuff you're used to hearing about. I think for much of the last decade, sustainable finance has been dominated by one overriding question: how do we decarbonize the economy? But in Africa, and particularly in South Africa, the much more important question is who's excluded from the economy in the first place. Now, South Africa's housing deficit is estimated at roughly 2.3 million units. But the problem isn't simply a shortage of land or bricks or even demand. In many communities, there are landowners willing to build rental accommodation and tenants willing to pay for it. What's missing is appropriately structured capital. Now, RMB has partnered with property fintech business Indlu on a R1 billion blended finance program intended to fund small-scale rental developers who have traditionally struggled to access conventional bank funding. It combines concessional and catalytic capital, a construction warehouse facility, long-term bank funding, and ultimately securitization. The bigger ambition isn't merely to fund a few thousand rooms. It's to prove that small-scale affordable rental housing can become a credible, scalable, and investable asset class. So to unpack the structure, I'm joined by Alessandro Scalco, who is a sustainable finance transactor at RMB. Alejandro, welcome to Due Diligence. Before we get into the mezzanine tranches and the construction warehouses, just tell us briefly about your own route into sustainable finance and what does a sustainable finance transactor actually do?
Thank you, Michael. Yeah, so I think I've had a bit of an interesting route into sustainable finance. So I'm actually a lawyer by training and was a legal counsel within the group in Ashburton Investments for a few years. And then over time, started to do a lot more of the private credit and private equity space and spent quite a few years building different fund structures on that side. And in that, started to actually see a lot more impact investing, particularly from some of the funds we started to set up. And then a couple of years ago, RMB set up its sustainable finance team under Nigel Beck. And Nigel was quite a visionary in this space and saw the need for, blended finance and structuring in the space to start to become mainstream and start to kind of unlock more than just your traditional sustainable finance type deals, but to start to really have that impact on the ground. And the stars aligned for me, I guess, and had a few conversations and joined Nigel's team, and so been with Nigel and the sustainable finance team for 2 years and very much working on these innovative structures and seeing how we can use the different pools of capital available to us, whether it's commercial, concessional, international funding, to unlock development goals and objectives in South Africa.
And I mean, you touched on so many hot button issues there that I want to come back to, but it really is encapsulated by this idea that we've got to move beyond vanilla green bond thinking. We're in a country where we've got all of these real world developmental challenges, be it access to housing, be it the need to fund water projects in a water scarce country such as South Africa, our own decarbonization journey. And I know there had been a period where people were becoming a bit tired of ESG and the three-letter acronyms, and there was a lot of greenwashing in the space. Then we saw the rise of Donald Trump, and that certainly hasn't helped. But it's been very interesting watching RMB under Nigel Beck's leadership double down on this, but in a way that goes beyond just the green label and really looks at the fundamental opportunity set. What was it about the philosophy that really attracted you to joining the team?
Yeah, I think it's exactly that. I think it's obviously working with someone who kind of has pioneered the space like Nigel is always a great opportunity for someone to learn from and someone to see. And, sometimes you don't always see the clarity of what he sees in his visions, but you got to trust the process a bit. And I think that's what's kind of happened over the past 2 years. He had a vision and he's helped guide us. And I think that for me, it's the belief in that actually I believe in the vision and I believe in that we can actually use our financial institutions to not only kind of protect depositors' money and investors' money, but also to do good. And I always use a thing to say to someone, there's always an argument around pension funds and pension fund trustees to say, My only objective is to ensure that the pot of money at the end of retirement is the biggest pot available. And then my argument's always like, but the pot can be the biggest, but if the infrastructure around you is falling to pieces, the pot's going to go to fixing the infrastructure, and then your pot's going to be even smaller than what it could have been if you invested smartly. And so I think it's about knowing that we can be stewards in a different way and using the institutions in South Africa in a way that kind of has that ability to be a good steward. And RMB and Nigel, they've seen that vision and they believe in that.
And it's, we have this recurring debate. It goes quiet every few years and then it returns around prescribed assets. And a lot of it is just good old common sense. We want to live in a prosperous South Africa. We want to normalize after years of the abnormality of apartheid. And that means investing in parts of the economy that were underinvested in during that period of kind of structural segregation. Housing is one of those. It's something that is a legacy of a period that we're all trying to eradicate. And our housing gap is, I think, roughly 2.3, 2.4 million units, give or take. What is the big challenge here that attracted you to partnering, before we get into the structure, with Indlu Living and its CEO, Kobus Trutter?
So I think, we were very fortunate in that we had a very good partner in Indlu, and they believed in their vision. They've believed in their vision for many, many years, and you could see that in the way that they have been running their business. We saw the opportunity when they came and presented to us, and they said, this is what we've been doing. We're looking for a way of, moving from a bit of a disparate funding source and bilateral arrangements to consolidating, being able to scale, being able to tap into capital markets. And, we as a team, we sat down, they presented to us. And I think what really struck out for us, initially was Kobus was not only passionate about, trying to raise the funding, but he was passionate about his business. He was passionate about the impact that he has. And, in the discussions we had with Kobus and the team throughout, there were cornerstone principles that were fundamental to him. And those were things like the rate of interest that gets charged to the property entrepreneur, how we treat the property entrepreneurs, the ecosystem, the protections that are afforded to the tenants through using the platform. And, those are the things that kind of, that you're working with an outfit that is going to be able to live their vision and you can grow with them. And obviously there's a commercial opportunity behind this. And we could see that, and we could, through the sort of team, through the benefit of working with very smart people across R&B, unlock that with the team, and also just the ecosystem across the group, being able to plug into various partners within our group, our foundation, our treasury teams, to kind of unlock this from all sides. So I think it was very much a bit of a stars aligning, but again, starts with Kobus and the vision he had, and always been focused on the impact that he has. And that was a cornerstone of everything we did for the past sort of 2 years in getting us over the line.
Talk about that vision, maybe for listeners who might be unfamiliar with what Indlu does. As far as I can see, it's built on this really deceptively simple idea that township homeowners are already property entrepreneurs. They're just not really treated as such, are they? They're going out, they're renting out back rooms. What is it that Indlu actually does?
Yeah, so that's kind of very much exactly it. So a lot of these people in the townships, their main asset is their home, and they want to try and make a profit out of it. And where Kobus and him saw the vision initially was the backyard rental market and helping people turn their existing assets into income generating assets. And that was through helping them transform or build backyard rental units. And the way in which Indlu's work, which is really sort of an innovative way of working and actually really de-risks from a financial perspective as well, is they control the ecosystem. So they provide the loan funding, but they also help with the architectural design, the town planning approvals, so they also maximize the use of the land. And then also the units get put onto an app, and people rent through an app. So, there's a lot of digital impact and penetration in these economies and in these communities, and they use an app like an Airbnb app. So it really does they own that ecosystem, from the construction, the lending, the construction, the town planning, to even the renting through the app. And there's a lease agreement that an individual signs on that. And where they saw a shift in the market over the last couple of years was individuals who had moved out of the sort of townships and had moved into and still owned the land, but wanted to use the land as an asset still. And they call these independent property entrepreneurs, and that's what we're focusing on with this model. And so they've actually transformed entire plots of lands into rental units, and they rent it out. But again, even those individuals that don't have access to traditional funding sources like a bank, they can't approach a bank and say, please give me a home loan. I want to build on this piece of land. And the program that we're developing, we're hoping in time, will actually open the banks to this market.
And how are you hoping to do that? Because, one listens to that and one thinks, well, this affordable rental housing could be attractive from an investment perspective. Yet it's still a very nascent asset, and one that to this point, the banks haven't really stepped in and funded. You come now with this blended finance opportunity. What makes this attractive to you from an investment perspective? What are the default rates like? What are you seeing in the model that you think will crowd in more private capital once you get the structure rolling?
Yeah, so I think that's the interesting thing. Sorry, just you touched on the default rates. When we got the data, and Kubis and them are a tech company, they will tell you they're a prop tech company or fintech company.
Yeah.
The default rates are lower than what you would find in most other regions in South Africa, in most other communities. The biggest sort of gap they have is when one person leaves a unit and moves into another, and they have to find another tenant. And that's on average maybe a week or 2 weeks to close that gap. And it really speaks to what we learned, and what I learned personally was, it's a different community. There's unwritten rules that we're not aware of. And one of them is actually, when you're in those communities, often the people staying there because they want to be close to work. And it's cheaper for them to get to work if they stay in those type of communities. So they would rather not be seen as a bad renter than not leave a property or default. They would rather just leave, lose their deposit and leave so they can find a place somewhere else close by within that community, because it's a different environment to what we used to seeing in, the Santons and the Northcliffs and the Rambergs and stuff like that. And I think that was really, really interesting, is as we start to scratch into that data that they had, we could actually see, but this is very commercial and better, like default rates and better, returns than you would get in other formal markets. And so that was a very, very eye-opening thing for us. And in that journey, we brought into the transaction and securitization our colleagues from FNB. And by bringing them in through a de-risk structure where they've gone, the properties have gone through the warehouse, and then FNB is funding the long-term securitization structure, FNB is taking a risk when the property has kind of moved through the riskiest phase of construction and it's now been rented. And so what they will start to see is, for their own side of it, the data around how are these books performing, how is their investment performing. So what it will lend itself to is, in time, them being able to kind of start to reassess their credit models for these types of communities and for the property entrepreneurs in these communities, because they will start to have their own data to be able to utilize to start to better inform their credit decisions.
And that's just remarkable. If we think what that will enable, lower interest rates, without a doubt, with that data and understanding of the book and the market and the risk profile of it, maybe longer tenors, higher loan to value ratios, more flexible security requirements, and greater tolerance for early stage losses. It's exactly what we need to see to unlock further growth in this particular part of the market, which is massive. You chat to people like Gigi Alcock and others who go and examine the township economy. There is a huge ecosystem and rules that are not really well understood until you go out and, to your point, you meet people who are working in those areas and your eyes are opened up. Take us through the capital stack from the bottom up. So you've got the First Rand Foundation. They've committed 30 million concessional loan to help establish the construction warehouse. Then you've got FSD Africa. Then you've got FNB's come in with 400 million. Just take us through the capital stack.
Yeah, so we've got the warehouse facility was what you mentioned now. So that's 30 million from our First Rand Foundation as an impact investment. So again, that's not grant. It's a concessional return, but it is a return nonetheless.
Right.
There is FSD Africa, which was the biggest anchor investor. They were 111 million rand. And then there was First Rand, and then RMB invested into the structure as a commercial investor for 50 million. So that's 191 million in the warehouse facility. And how the warehouse works is it advances loans in tranches of 50 million rand. And the 50 million rand then is used by, it's an average loan size of, let's say, 2 million rand that gets given to the property entrepreneurs. Can be less than that, but it's about 2 million rand on average. And they will then, what will happen is, it's a typical securitization structure is they'll use the funding, Indlu will use the funding to construct the properties, build, get the town approval, do everything. And then there's a stabilization period. So once the properties stabilize, meaning that for 2 months they rent it out, then those properties are sold into the securitization. The funds that are then paid by the securitization are, the securitization has FNB invested, FSD Africa is also a mayor's investor. We have some institutional investors who are finalizing their commitments into it. And what we have then is the funds that are received from the securitization are given back to the warehouse, and the warehouse advances that again to new property entrepreneurs.
Oh.
And so the 191 million essentially is going to recycle itself or be reused about 4 to 5 times over the next 3-year periods to build up to about 750 million rand initial securitization tranche. And that will then be your first tranche of the program. So it's a very efficient way of using the warehouse to kind of, recycle those funds over a 3-year period to build up into the capital markets, quite a large sum of money. That should get you, they're estimating it's going to be about anywhere between sort of 2,000 to 5,000 loans. And if you're looking at 4 to 8 units, per a loan, you're looking at a solid, between sort of 8 and 12,000 rooms available that will be financed through this. So it's very high sort of impact. And the idea again is that we will start to look at the next tranche or the next securitization issuance in a year or two. Once we've got through majority of the warehouse and most of the securitizations up and running, we will then start the next tranche and build the next tranche. Because you ask Kobus, this is a 15 billion rand opportunity that he has in front of him, and he can make a huge difference. And so this is the start of something we want to build into the billions.
Yeah, well, you've just said that's 8 to well, potentially 12,000 rooms. That's just with this first tranche of, at a headline number, a billion, and you times that by 15, and you're getting to well over 100,000 rooms and people and lives that are being impacted by this. This is massive impact. For listeners outside the financing world, can you just explain then what is being blended here? Which risks are being absorbed by the catalytic or concessional funders, and which risks remain with the commercial lenders?
Sure. So the warehouse is probably one of the most catalytic tranche facilities because that's funding the construction risk, which is normally in construction projects the riskiest phase of it because there's no cash being generated during the construction phase. So all the investors in the warehouse are being catalytic. In the warehouse, there's also segmented across. There are, like, First Rand Foundation has come in with a slightly concessional rate to help keep the interest rates well within the sort of cornerstone principle that Kobus set us at day one, that we've always maintained, and we negotiated heavily with a lot of the investors. So all those individuals are being catalytic, but FSD and First Rand Foundation are also being concessional in that. So they're not absorbing on a first loss basis the senior tranche or anything of that nature, but they are also taking the most risk in taking the construction phase. That construction risk, if you didn't fund that, you probably wouldn't be able to launch a securitization because most institutional investors, there are a few out there that do construction risk, but they don't like construction risk, and a lot of their funds can't handle construction risk. So then within the securitization structure, we have a senior tranche, which is your normal institutional investors, and also that's where FNB is also participating. But then we also have what we call a catalytic mayor's tranche, and that's actually a very catalytic tranche, and that's where a lot of the blending also happens. So it's in the warehouse to an extent, but also the de-risking that it is achieved through the warehouse. But then also within the securitization, there is a catalytic mayor's tranche, which is funded at a rate which is essentially the same rate as the senior, but subordinated from a security and a payment perspective. So meaning that in the case of a default at the securitization level, those mezzanine investors are actually going to be only paid after the senior investors have been paid. And they're not getting a much higher, if not the same, interest rate as the senior investors. And the reason they're participating at that level is because they know that they need to provide that protection, or credit enhancement is often the term used, but it's protection for the senior investors. And then below that level, Indlu team have also put money in themselves. So Indlu's also put money into the warehouse. They've put, I think it's about 6 million into the warehouse. And then they've put about 70 million into the securitization as an additional layer below the mezzanine funders, also at a rate which would arguably below the market for that level of security. So there's about 2 layers in the securitization which are slightly concessional and being used to enhance or protect the senior and credit enhance the structure. And then also within the warehouse, there is that tranche provided by Indlu themselves in that. And also a really important point is the reason we wanted them in both, and I think any investor, but for a non-investor, is that you create an alignment. Their money's in this as well, and there's alignment on both sides of the structure.
Yeah, and I mean, we'll come to that transition from construction finance into long-term funding, because I think it's crucial, because a warehouse can become an expensive parking lot if loans fail to graduate. But let's just follow one loan through the system. So a landowner wants to add several rental units to an existing property. The construction warehouse advances the capital, the units are built, tenants move in, and then the rental streams begin. At one point, is that loan then considered sufficiently seasoned or stabilized to move out of the warehouse and into long-term funding?
It will be 2 months of rental.
And that's it. And then you can recycle that capital. And I think that's what makes the model so interesting and so scalable as well. When we look at who carries the construction and tenanting risk, I think it's probably the riskiest stage of the process. Who carries that if a project runs over budget or takes longer to complete or struggles to get the tenants and reach the expected occupancy level? Does Indlu manage all of the approved contractors and payments against kind of various construction milestones? How is that managed?
That's a very important point. So I think actually that's also one of the things about the ecosystem that Indlu's built here. Is Indlu is part of the sort of, when they advance the loan or they give the loan, they not only do the town approval, they appoint the contractors. And what they've done is they've developed and they've trained local contractors in the communities they work. So a huge job creation angle to it, and it also creates a sort of a lot of vesting of pride in the people who build. So we asked the question, how do you deal with the sort of construction mafia to them? And I said, we have no issue with that because we use local contractors and everyone, trusts each other. So they use local contractors, and so they will pay to their local contractors who they've had relationships over many, many years. And they know the specs they need to build to. They know the standard they need to build to. As part of the process, we've also built in that our quantity surveyors will do sample testing on the units just to ensure that we're comfortable from an investor perspective that the units are being built according to the specs that they say they're going to be built. But I mean, if you go out into Tembisa and you just go to you drive through, you will see the Indlu buildings. It's white and it's green painted, and you can see them scattered throughout. And it's distinct in Tembisa, the Indlu rental units that are there, and they just look different. They look well maintained. Indlu also does maintenance throughout, so a portion of the rental that's received through the app and through the tenanting actually also goes to a form of maintenance. So there's also like a pride about how these buildings are maintained, the level that it's maintained at, and even small things. I think, Michael, it's a really important point, is just that Indlu try to plant trees around the places that they build. And the reason they've said that is because the science has come out that the townships, these local communities are 2 degrees hotter than suburbia because there's no trees.
Yeah.
And so they try and small things to try to uplift just the surrounding communities that they're building. So again, to your point, they use local contractors. They control the flow of fund to the contractors. They know how to budget per the construction costs and all of that sort of thing.
Incredible. Now, if you distill it, and it's still a very complex structure, but if you were to distill it down, you're talking about lending to borrowers who have historically struggled to access bank funding because they lack the formal collateral or conventional credit records. So would it be fair to describe this then as cash flow lending supported by data rather than conventional mortgage lending? Because you're basically trying to replace traditional collateral-based underwriting.
Exactly. I mean, it's exactly it. We're more focused. I mean, even in the analytics we did, we were more worried about showing that the units will be rented, and because you pay from the rental of the units, that's what you pay from. You're not looking at someone's salary slip. You're not looking at someone's, as you say, other collateral. You're basically saying, in vetting a property, Indlu say, do we think that putting this property here with 8 units will attract sufficient rental from sufficient people? Yes. Okay, that's a business. We can grow then. And then you take risk on it actually being rented. So a lot of the due diligence is the cash flow.
And with that platform, does that allow you as the financiers to see all of that data in real time? And can you monitor the occupancy and the collection rates and arrears and all of that through the platform?
Yes, Indlu has all of that data, and they will give us dashboards of what the occupancy rate is. I mean, it's all of that. And what's really interesting is they'll show you, like in, for example, a January, December, when a lot of people go home for the holidays, the rental units drop off because people have gone home, because they only do month-to-month contracts. So people will terminate the lease, go home, come back, and then in February it picks up again. So all of that data you can see in real time. It's so interesting.
Really is. And I think one attraction of the model is the granularity of it that's allowed by the data, because instead of going out saying 500 million rand property development, you've got a portfolio of many smaller loans across multiple landlords and communities. All of that spinning over into jobs in these communities and ecosystems obviously reduces the single asset concentration risk. It does introduce maybe a different problem in that you've got thousands of small operational and administrative risks, but you've balanced that with the Indlu model. Just turning, as we are running out of time, Alessandro, to how we build this into an institutional asset class. Obviously, FSD Africa Investments has spoken about anchoring this new asset class, and ultimately we want to attract institutional capital, as you've said. What still needs to be proven before pension funds and insurers or specialist credit investors will be comfortable owning this paper?
Look, I mean, I think for now, I think we'll see more asset managers come into the space. I think, it's a good yielding asset. And I think once they start to get comfortable with the risk profile, they will start to come into it. Unfortunately, I think South Africa institutional investors are quite risk adverse, understandably, because it is third-party money. But I think it's just a matter of time. And I think once we've proven the model, I mean, our intention always is that the next sort of issuance will be over 1 billion. And we won't have any catalytic or concessional tranches in that issuance, because we fully believe that this model only needed to be de-risked to prove the viability of it versus actually having to continuously de-risk it. And in time, we think that the institutional market will see this as a good investment. And as you say, there's a lot of, whilst there's a lot of risks in that the construction phase, and there are sort of underlying, individual loans, and there will be quite a few of those, Indlu set themselves up in such a way that it's very automated. So a lot of the risks that you would ordinarily see have been de-risked already. So I think it's a matter of time. I think even into the securitization, when that's announced, you will see there will be institutional investors in that one as well. So we'll start to see the market move into the space.
It's just an incredible model, because if you just look at the numbers so far, 64% of Indlu's current landowners are women. And the model has reportedly supported more than 1,000 short-term construction jobs, nearly 400 permanent roles through local SMEs. So beyond the housing units themselves, which is already solving for this big national challenge, you could be creating a new class of small property entrepreneurs that, I mean, you can see these property entrepreneurs graduating from building 4 units to 8, then 16, eventually becoming meaningful local residential developers. Fascinating. Alessandro Scalco, thank you very much. Really interesting to see the work that RMB is doing in the so-called ESG space. It's more than that. It really is properly impactful finance, and great having you sharing a little bit more about the model and how it's all come together. Take care.
Thank you very much. Thanks for your time.
Well, that was Alessandro Scalco, Sustainable Finance Transactor, talking to us about very interesting model. And in fact, the most interesting aspect may not even be the 1 billion rand headline number. It's the attempt to convert thousands of small dispersed rental properties in the townships into a transparent and standardized and investable pool of cash flows, using catalytic capital to absorb the early risks and commercial capital to provide scale. If it works, it could help close part of South Africa's housing gap, while creating a new class of property entrepreneurs and a new asset class for institutional investors. You've been listening to the Monocle Banking Podcast, as always proudly curated by Monocle Solutions. If you've enjoyed today's discussion, subscribe wherever you get your podcasts, and join us next time as we unpack more from the front lines of business and deal making here on the Monocle Banking Podcast. Take care.